Welcome to the Money and Meaning Show with Jeff Bernier, a show dedicated to helping you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most.
Well, hello, everyone, and welcome to the Money and Meaning Show, where we attempt to have a deep conversation around meaning and purpose and what gives you joy, and put the financial plans in place to give you the freedom to go pursue your vision of a meaningful, purposeful life. My name is Jeff Bernier. I'm your host and guide on this journey, and today is a perspectives broadcast. So we bring on guests on these shows to dig into some of these topics, and occasionally I'll do a little solo act here with an idea or a thought that I think might be helpful and timely. So that's what we're doing today. And today is a very important one for this time of year, because as we start rolling into year end, this is the time for tax planning, for year-end tax planning. And probably even more important this year than some because of the most recent tax law changes that have been put in place. So my encouragement for you today is to hear some of this information and get motivated to at least take a look at your situation to determine, are there things that you should be considering before year end? So that's what we're going to talk about today. We're going to talk a little bit about year-end tax planning. I am going to highlight specifically charitable giving because I think there's some unique opportunities there for many of you. But I want to talk about broad tax planning in general as well. And I want to start by just giving you just a very quick summary of a couple of the key points in this tax legislation that I mentioned. So as you're probably aware, recently Congress passed and the president signed the One Big Beautiful Bill Act. Now, I did a perspectives broadcast about a month ago with some concerns I had about the size of our government and the lack of attention that we appear to be paying to some of our structural problems. Well, I'm not going to go back into that today, so you'll be spared my lecture. But I do want to talk a little bit about some of the provisions of the Act and why right now you really should consider taking a look at your circumstances. So let me just kind of go through a couple of the key provisions. Again, I expect a lot of this will be a review to you. One is the standard deduction was raised again. And one of the good things about the bill is that we at least have more certainty about tax rates and deductions and those kinds of things, at least until the next act is passed somewhere down the road. But as compared to the previous act that was going to sunset, we at least have more certainty. And one of those things is we do have higher standard deductions. And so what that means is many people will still not itemize their deductions. They'll take the standard deduction. The child independent credits were expanded for some taxpayers and phased out for others. And just as an aside, like most tax acts, it is a mixed bag. You know, there will be some things that we'll all like about it, and there will be some things that we don't like so much about it. But at any rate, the child independent credits have been expanded for some, curtailed for others. There's also now a cap on certain itemized deductions for higher income earners. So if you're in the 37% federal tax bracket, your itemized deductions are deductible at a lower rate, 35% instead of 37%. But one of the biggest changes is the SALT deduction cap was lifted. So with the SALT deduction cap, SALT stands for state and local taxes. So in the previous act, those were capped as deductions up to $10,000. That was the maximum deduction you were able to take on your federal tax return for state and local taxes like property taxes or state income taxes, things of that nature. Well, that's been expanded. So instead of a $10,000 cap, it's now a $40,000 cap for most taxpayers. Now, as you get into the higher brackets, those are phased out that we will talk about in just a moment. So the reality of that is there may be more people, if you're in a high tax state or you have a lot of state income tax, you may be itemizing this year where you didn't itemize last year. But those that don't, again, because of the higher standard deduction, many people will still not itemize their deductions. And what's important about that is if you don't itemize your deductions and you make a charitable gift, while charitable giving is an important thing to do for society, it won't save you any taxes if you're not itemizing. So that's just a few of the big items that we'll talk about, or at least some of this year-end planning will be related to some of those items. But before I get into those, let me just go through a few thresholds that are important. And so I think these have become sort of cheat sheets to me as I'm working with clients year in to know what these thresholds are. Well, I already talked about the state and local tax deduction, where you can deduct your state and local taxes, but that phases out. You're still capped again at $10,000 if you make more than $500,000 a year. That's modified adjusted gross income. So that's your gross income approximately. So it starts phasing out at $500,000 in income, and it's completely phased out at, I think, around $600,000 in income. So if you have $600,000 or more in modified adjusted gross income, your state and local taxes are still capped at $10,000, just like it was in the previous law. But if your income is under $500,000, you may be able to deduct up to $40,000 in state and local taxes. The second one, the threshold that I want to point out, really affects people who are over age 65 and on Medicare, and you're paying a Part B premium for Medicare Part B. That premium goes up based on your income. There's an additional, it's called IRMA. Premium goes up once you meet a certain threshold, and that threshold for married filing jointly is $212,000. So as we talk about deduction strategies or even accelerating income strategies, if you're trying to stay under the additional Part B premium and you're married filing jointly, you'd want to keep your income under, your adjusted gross income under $212,000. So that's the second threshold. The third one is there is a new deduction for people over age 65. It's $6,000 per person. So if you're married filing jointly, there's a $12,000 additional deduction for those over 65, as I mentioned. And that begins phasing out at $150,000 if you're married filing jointly. And it's a $6,000 deduction if you're single. And the $6,000 single deduction phases out at $75,000. So that's a $150,000 threshold that we want to pay attention to in terms of if we're accelerating income, as I mentioned. Do we want to try to stay under that threshold? I talked earlier about the itemized deductions being limited or only deductible at 35%. Well, you actually hit that 37% tax bracket at $767,000 in taxable income, married filing jointly. So that's another threshold. And then the final one that I think many people oftentimes forget about is we have a 0% capital gains rate, federal capital gains rate, if your taxable income is under almost $97,000 married filing jointly. It's actually $96,700. So if you're married filing jointly and your taxable income, in other words, after your itemized deductions or standard deductions, is $96,700 or less, any capital gains that you had up to that income would be tax-free. No federal taxes. There would still be state income taxes, at least in Georgia and probably most states. So that's another threshold, $96,700 if you're married filing jointly, about $48,000 if you're single. So those are some thresholds. So as we talk about deduction strategies, oftentimes it's to get us, if we're close or right over a threshold, it can get us below a threshold for an additional benefit. Or if we're close to a threshold, if we raise income, it's going to throw us over a threshold and our tax can go up a lot with very small incremental increases in income. So we want to pay attention to that. So the state and local taxes at married filing jointly start phasing out at $500,000, at least the cap. The Medicare Part B premium, the threshold is $212,000. The $12,000 additional deduction if you're over 65 starts phasing out at 150,000. And then again, the 0% capital gains rate is income 96.7 or less, you'll be at a 0% capital gains rate. So all this means is, especially with some of these provisions, is year-end planning is really important to see kind of where we are year to date to see if there's opportunities. And again, the new tax laws just accelerate some of this planning. So let me talk a moment about gifting. So one of the reasons gifting can be so important is charitable gifting, especially with low basis stock or low basis securities. In other words, securities that you've got big gains in can be particularly attractive. So let's say, for instance, you've got $50,000 worth of a security that you paid $10,000 for years ago. Well, you can contribute that security to charity and take a deduction, a charitable deduction, maybe as much as $50,000, depending on your adjusted gross income. So you can deduct the fair market value of the security that you gave to charity, and you've got that $50,000 deduction, and you've, again, since they're a charitable entity, they don't pay tax when they sell the security, and you've basically given them this $50,000, and you've eliminated the realization of that $40,000 capital gain. So it's a high-powered way to give money to causes that mean something to you. So that's the big idea, is you can deduct the fair market value of the gift. Now, the deduction is limited based on your adjusted gross income. It's 30% of your adjusted gross income. So if you give low basis securities, you can deduct up to 30% of your adjusted gross income in that 1 year. And any deduction that you were eligible but didn't qualify for because of your adjusted gross income does carry forward. Now, as I mentioned, we've got this SALT deduction. So what you might be able to do, if you are charitably inclined, you could give gifts to charity, which would bring your income down, which could get you down below the $500,000 so that your state and local taxes are deductible up to the full 40. So you see, all this works together in terms of your planning. And so why year-end matters so much is, we've got to do all this stuff before year-end. You're not able to do these strategies in January and get a benefit for 2025. So these gifts, if you make a charitable gift, it's got to be completed by December 31st. Another strategy that we talk about is, if we're going to do charitable giving, but we don't itemize, we can bunch our deductions into 1 year by using what's called a donor-advised fund. So another strategy might be, we'll take several years worth of charitable gifts and contribute it in 1 year to a donor-advised fund, which is a qualified charity, and you get the tax deduction in the year you make the contribution. So let's say I give $10,000 a year to my church, and I don't itemize because I don't get over the roughly $32,000 in standard deduction. Well, instead of giving $10,000 a year to my church, what I could do is I could go ahead and put $50,000 into a donor-advised fund and get a tax deduction. And then out of the fund for the next 5 years, I can make the gifts to the church. But I've accelerated the deduction, and I got it all in 1 year, which is obviously way above the standard deduction. So I was able to deduct the full value of the gift to the fund, but I'm still making the gift to the charity for the subsequent, 5 years essentially. And then for years 2 through 5, you're just taking the standard deduction because you're making your charitable gifts out of the donor-advised fund. So a donor-advised fund is a terrific vehicle for planning in bunching these deductions to get you past the threshold, even if you want to give the gifts out. And of course, you could combine that by making the gift to the donor-advised fund with low basis securities. You could give cash, but you're better off giving the low basis securities. Even if you've got, we've had a really good market. And so if you've got, a tech stock that's gone up a lot, you could give shares of the tech stock to the donor-advised fund, get the tax deduction, And the cash you would have given to the charity, just take the cash, put it in your portfolio, and repurchase the security. So you still own the stock, but you got the tax deduction and you wiped out the capital gain. So now if you sell the stock in the future, your capital gains taxes will be significantly lower. So that's the beauty of bunching and donor-advised funds in conjunction with low basis securities. And of course, finally, if you are over age 73 and you're taking required minimum distributions from your IRA, qualified charitable distributions can also play a big part here in year-end planning, because making your charitable gifts out of the IRA reduces your taxable income. But if you don't itemize, if you'd written a check, you wouldn't have deducted it anyway. But if you give it part of your qualified charitable distribution or all of your qualified charitable distribution to the charity, it reduces your income, and then you still get the full standard deduction. So it's a much more high-powered way to make gifts to charity if you're over 73 and required to take distributions from your IRA, and still get the benefits of the charitable gift because you've reduced your gross income, which can, again, filter through to some of these other thresholds. So if you give part of your required distribution to a charity through a qualified charitable distribution, you've reduced your modified adjusted gross income, which might be what you need to do so that you are able to qualify for the $12,000 standard deduction, the additional standard deduction. If that was what was necessary to get you under the $150,000 threshold, it's even an additional benefit. So all of this kind of plays together. And as we're looking at these year-end opportunities, we also don't want to forget about the benefits or potential benefits of Roth conversions. So a Roth conversion is when you take a traditional IRA that you contributed to and got a tax deduction for, or a 401k, and you got a salary reduction, so it saved you taxes when you put money in the IRA or in the 401k, and you move it to an IRA, you have the ability to move that to a Roth IRA and pay tax today. So you can combine some of these deduction strategies with Roth conversion strategies so that you are able to move money from traditional IRAs that will be taxed at ordinary income into Roth IRAs at favorable tax rates. And as long as the money's in the IRA for 5 years from the time the account was open and you're over age 59 and a half, the income and the gains would come out of the Roth IRA tax-free. So it's really just a matter of coordinating a number of these ideas. But the thing about, let me just finalize a couple of thoughts here again on the use of the donor-advised funds. So the benefit here is you can give cash or appreciated securities. If you give appreciated securities, you've avoided the capital gain and you get the deduction. And then, of course, you don't have to decide right away who the ultimate recipient is. Now, the recipient that you send the money to ultimately has to be a qualified charity, but by combining these strategies, you can really create a tremendous impact. I didn't mention it, but also some of these deduction strategies, as I did mention earlier about the 0% capital gains rate, but I didn't really talk about it in terms of integrating. But some of these strategies could get you below the 96.7 in taxable income, meaning you could potentially sell some securities at a 0% capital gains rate. So it's really just a matter of looking out on an annual basis. This is not something you can forecast several years out, but you really have to do year-to-year projections to see what's more valuable. Should I do QCDs? Should I sell stock at a 0% capital gains rate? Should I do a bunching strategy with donor-advised funds? All this can play together, but there's no magic formula. Everyone's situation is different depending on your cash flow needs and your giving needs. And in terms of the donor-advised fund, questions you ask is, what causes do I care deeply about that I'd like to support? How can my resources reflect those priorities? And what legacy do you want to live? I mean, these are the kinds of questions you would ask as you're setting up donor-advised funds, and some of these charitable strategies. So what should you be doing now? Well, my recommendation is to look at your year-to-date 2025 tax circumstances. A good place to start is look at last year's tax returns, carry it forward, and then take a look at what has changed in 25 over 24 to see where there might be headroom or where you're already over a threshold that a small additional charitable or additional deductible gift could have a huge impact. Number two, identify if you have any appreciated securities that might be eligible and appropriate for gifting. Consider whether a donor-advised fund is something you understand or feel comfortable with. There are several that are out there that are terrific. Explore whether bunching, the 0% capital gain harvesting, or Roth conversions make sense. And then, of course, collaborate with your financial advisors and your tax professionals. This is designed to be general advice. I'm not trying to give you specific advice. Every circumstance is unique, but it's an area where true collaboration can put real dollars in your pocket through tax savings, and you can express your values to causes that mean something to you. So you can basically take advantage of directing your social capital. You know, you're going to pay taxes anyway. Why can't I save some of those taxes and redeploy the capital to causes that mean something to me, where the government bureaucracy may not be quite as aligned with your values? So the takeaway, the new tax law has shifted the playing field in certain circumstances, but with thoughtful planning, you know, you can turn this into an opportunity for yourself, your family, and the causes that you care about. But don't wait until January. Don't wait till mid-December, as a matter of fact. I mean, the window closes at year end, but it takes some time to understand how all this works together. So my encouragement is to get started and reach out to your advisors or other professionals that can help you, but don't wait till it's too late, because there may be a unique opportunity. So thanks for joining me today. I know I might have gotten in the weeds and got a little excited about some of these ideas, but I'm just finding it's really rewarding to show you and show our clients how they can do well by doing good. And you know, it is a virtuous circle, but also you're just being a good steward of the capital. You know, you're being thoughtful about the difference you want to make, and you're taking advantage of the free bridges that are out there. So I hope you found it helpful. Thanks for checking in. If you found it useful, please let me know. You can reach me by email at moneyandmeaning@tandemgrowth.com. You can certainly check out our company website, tandemgrowth.com. And of course, you can check out past episodes of the Money and Meaning Show, where you stream all your favorite podcasts. Would love to hear from you, and would love a rating if you found something of value, and would like to give me some feedback. So thanks for your attention today. Hope you found it helpful, and get to that year-end planning. Thanks so much.
Thank you for listening to the Money and Meaning Show with Jeff Bernier, a show dedicated to help you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most. We would love to hear from you. If you have any questions or comments on the show, feel free to reach out to us at moneyandmeaning@tandemgrowth.com, or you can find us on the web at www.tandemgrowth.com. Jeff Bernier is the President and Chief Investment Officer at Tandem Growth Financial Advisors, LLC, an SEC-registered investment advisor. This show is a production of Tandem Growth Financial Advisors, LLC. All information discussed is general in nature, is provided for informational purposes only, and should not be construed as specific financial, legal, or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Listeners should not rely on the content of this podcast as the basis for any investment decisions. A professional advisor should be consulted, and/or independent due diligence should be conducted before implementing anything discussed in this show. While information presented is believed to be factual and up to date, Tandem Growth Financial Advisors, LLC, does not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Tandem Growth Financial Advisors, LLC, does not make any representations or warranties as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by any unaffiliated third party, such as guests on the podcast, and takes no responsibility for the same.